So next up, we're going to talk about Bitcoin and volatility and how emotions can play a part in how you manage Bitcoin's inherent volatility. So crypto markets are notorious for their volatility in comparison to traditional financial sectors. When we're talking about volatility, we're referring to the dramatic shifts in price movement, price action. Whereas, let's say we're tracking the S&P, and we might see a 1 or 2% move, which is a lot considering it's such a large asset and so much capital is invested in it. Whereas Bitcoin might see a 5 to 10% move, and then altcoins might see a 10 to 15% move, even larger price swings. And this is something that crypto is known for: these large price swings compared to traditional equity sectors and commodities. Now, coins can often increase and decrease in valuation at the same rate. So just as quickly as it went up, it can quickly go down. And there are instances of coins decreasing in value even faster than the time it took to increase to that point. So this is something that is very common, or even happens more so. It always takes a certain amount of time to increase, even if it is faster than traditional markets, but it typically decreases even faster, right? The flash crashes are very common in crypto during pertaining to specific events. There's a saying: the coins will take the stairs going up and then the elevator going down. Now, extreme increases or decreases in price can often have a serious effect on the emotional state of traders or investors, causing them to FOMO, fear of missing out, to avoid missing out on gains, or panic sell in an effort to avoid losses without taking a look at the underlying reasons why these events occur. People see green colors or red colors and they either buy in or panic sell, and they fail to really have a broader understanding of what's going on in the market. And this is what really separates experienced and profitable traders from everyone else: having that underlying knowledge and using that knowledge in key moments to capitalize on what's happening in the market. Now, panic selling, FOMO buying, and other emotionally charged decisions are not related to trading. Really, this is the other side of the coin, where it's simply just gambling. If it's not based on analysis, if it's not based on strategy, it's not based on research and rules, then the trade is just simply gambling at that point. You're just betting on something that you hope will happen and not necessarily something that you feel is likely to happen. So here's an example of a FOMO trader's experience where, let's say, price is starting to go up and we're in some sort of uptrend in the market cycle, and there's fear and there's greed and excitement, right? At these particular moments, prices are going higher and higher, and this is where we start to peak out. And this is where they say, oh, I want to buy in, I need to capitalize on this. But they already missed out on what really made this the uptrend. They missed out on the bottom or even the lower part of the move up. They waited till the top and they bought the top, and now price comes down and they believe in holding. Price reaches some sort of low. Fear and anxiety is at an all-time high in the market and in the community, and they panic sell. They see the red, that really deep red day, and they panic sell. They get out, and they're overall just impatient. They're not actually waiting for the best buying opportunity, and they're not waiting for the best selling opportunity. They're just doing it based on emotional responses. And at this point, they're becoming impatient, and the cycle just keeps repeating. So what we're going to do is we're going to take a look at a recent example of Bitcoin price volatility and talk about some different strategies and concepts that we could use in times of volatility. So the next slide, we're going to take a look at a daily Bitcoin to US dollar chart. Now on September 7th, 2021, this is just an example, we saw that Bitcoin opened at 52,698. It hit a daily high of 52,944, hit a daily low of 42,830, and then finally closed at 46,894. Let's take a look at what happened. So here's our example. During this time, this is from late July, we started to see the reversal of the previous market trend. The trend was downwards from that 64K, that all-time high, established in April and May of 2021. So for the next 2 to 3 months, prices were trending down. Bitcoin just touched below 30,000, and then we started to see a market reversal where we produced a high, higher than the previous high, a higher low, higher high, higher low, higher high, higher low, etc. This is the definition of an uptrend or a bull market, or the market is trending upward. It's made up of these consecutive higher highs and these consecutive higher lows. We reached a new high of 53K, and if we were looking at the full Bitcoin chart, we could have seen that 53K is actually a key resistance level, right? There are several key resistance levels, such as 30,000, 37K, 42K is a very important one. That this is a crucial placement, a pivot point that has proven throughout 2021. And we also saw 53K. Bitcoin was reaching up to this point, and it actually was sent back down. This was considered significant resistance. And at the same time, there were other factors happening on September 7th as well. We'll talk about those as well. But as we could see, significant red candle, Bitcoin opening and reaching a high of about just under 53, falling as low as somewhere almost about 42K, a little bit above 42K, and then finally closing around 46K. Note the tremendous amount of volume on this particular candle, right? Compared to all of the other candles, which the majority of them have been green, right? We saw significant green candles, particularly on July 26, indicating that there was significant buying pressure. There's a lot of activity on this particular day, and also here as well. But there was a notable large amount of activity on this day, and it ended up being green. This is an indication that, yes, we reached some sort of high. There was a big push to probably about a little bit over 40,000. Price came back down, but price continued to trend upwards, right? And we haven't really seen such a large volume candle. Here we do see another one, indication that once again, buying power is really saving Bitcoin. We reached some sort of low, buying power pushing ahead, lots of volume on here, and these are indications that the prices were going to continue to go up. This is really the first sign that we saw any sort of reversal of a shift from this uptrend, right? And this, in 2022, we know that this was a pause, and this was like a micro downtrend, if you will, resulting from this in September. But at the time, this large amount of selling volume on the 7th is definitely notable, and it was strikingly different compared to these particular days, right? We see this sharp decrease in price. It was a flash crash, if you will, and then the sudden uptick in selling volume. So this was just a general indication that we may have hit some sort of bottom, but also a possible shift in the trend. Here we're taking a look at the same scenario. This is on the 1 hour chart. As we can see, most of the price action really just happened within the span of an hour or so or two. Here we see Bitcoin's chart, 1 hour chart on September 7th. Most of the price volatility is centered from 9 to 11 a.m. EST. Take note of the volume increase during this time period, particularly right here. We see this sudden spike in volume. This is an indication that there was some sort of exhaustion, right? I mean, if you even just look up on here, this is a fairly small candle body with large wicks on either side, especially on the downside, indicating that there was some sort of exhaustion here, right? There was a buildup in volume, trading volume, lots of trading action of the asset trading hands, people selling, people buying as well. For the most part, the sellers did overcome because price did fall lower. But as we could see, price was actually way down here around 42,800, but then retraced back up to 46K, let's say. So this is an indication that price did come down, but at this point, the sellers could have considered exhausted, right? And this is an indication that maybe we hit some sort of distinct bottom way down here at 42K. So one could make the argument that this was some sort of near-term bottom where the wick went all the way down to, and could be considered a significant level. If price were to come back down to here, this is a notable area to take note of because price came down to here. It held at high 42K, and with the significant amount of volume indicates that there was a lot of interest in this particular move. So this gives more credence to this particular candle. This is a very important candle compared to the rest, which, not that they're not important, but if we compare in terms of volume, this particular area, we saw the most amount of volume by a large amount, right? Even compared to anywhere to the left and to the right of it. Particularly, these two candles were particularly notable. Now, there are a variety of underlying reasons as to why an asset price moves up or down. Many investors during this time period may have opted to panic sell their holdings as they saw the price crashing, and this was done in an effort to prevent further losses without taking into account of why the drop actually happened. Now, one of the major reasons behind the 9/7 flash crash was the amount of over-leveraged positions in the market. We're going to take a look at some charts pertaining to open funding rates and whatnot pertaining to leveraged positions. Now, while the news of the Evergrande default in China, particularly that was released on September 7th, may have acted as the spark or the catalyst for the general financial pullback in September 2021. We saw this not only in crypto, we saw this in equity markets, the S&P 500, several commodities as well. The amount of open leverage positions, particularly in crypto, acted as fuel to the crypto crash, which is why we saw such a stark drop in just 2 hours of about maybe about a 20% drop in Bitcoin in just one day. So here we see a chart. This is provided from Glassnode. This is the Bitcoin futures perpetual funding rate on all exchanges. Now, as we can see here, there's a center line here of 0%. Now, if we see green bars or the funding rate going above, this is an indication that more people are betting that the price of Bitcoin is going to go up. The positive rate indicates that there's more longs, people longing in the market, whereas a negative rate, these red bars, this indicates that more people are shorting the market. They're betting against Bitcoin. They're betting that it's going to go down. And the whole purpose of this is to maintain balance in the futures markets so that there's an incentive to long when more people are short, and there's an incentive to short when more people are long. If the funding rate is positive, this is an indication that the longs have to pay a fee that gets sent to to people shorting, right? The market, for every person that is opening up a contract, there has to be somebody on the other side of the contract. This is the point of a futures contract. You are placing a bet that you are going to buy the product at a later date, and someone has to agree to sell it to you. Vice versa, If you are agreeing to sell the contract on at a later date, someone has to be on the other side of that to agree to buy it from you, right? And we go more into this in the derivatives section of our lesson. So feel free to dive into that lesson for more information on longs and shorts and futures. But the main idea here is that we saw an uptick, a particular increase from July 26 onward of people longing the market. This was a notable shift because really from May into June and July, more people were shorting the market. They were betting against crypto, which would have made sense at the time considering the overall market structure. The market structure was pointed downwards, right? So in that situation, we're betting that prices are going to continue to fall. We saw an extreme shift, and what we see here is that there is an extreme topping off in late August, early September, where there was a large amount of buildup of futures, particularly longs, in as we could see here around, let's say, early September. This is an indication that any sharp move downward would liquidate all of these positions. And this is a much notable large amount of open interest compared to previous months, right? A lot of the interest was flushed out in May, June, and July because a lot of it was liquidated. There was hundreds of millions of dollars lost because of these open leverage positions that weren't maintained or closed at properly. So with all of these positions, we see this stark increase in leverage positions. Price starts to come down, and these are all long positions. So if price comes down and flash crashes down to their liquidation point, the position is immediately closed, and the asset is sold because there's a contract, right? These people said that we are going to buy this, and we are going to someone else is going to sell it. So these people were forced to buy the asset as it was continuing to fall. So prices were falling, the positions were being liquidated, forcing more of the market makers to sell, and inevitably this created a domino effect, right? Price keeps going down, more of these positions are liquidated, more money is lost, more of it has to be sold to fulfill their obligation, right? Because they're obligated to buy regardless of the price. And as a result, we saw some sort of situation where it's like a fire in a haystack. So here are some key takeaways regarding emotions in trading. Don't make financial decisions based on emotion. This includes FOMO buys or panic sells. Keep a clear head when navigating financial markets and investments. If you feel yourself becoming emotionally attached, you're probably overextended and you probably need to cut down on your account size. Also, follow through with your analysis. Both technical and fundamental data are based on-chain and exchange-based data that does not factor in the human element. Trust your analysis and your plan once it's created. If you feel like you need to constantly change your plan regarding a trade, then you should probably not take the trade.